Scene 1. What if financial crises aren't accidents, but instruments? What if the same institutions tasked with stabilizing the economy quietly benefit when it collapses? Every recession is framed as unpredictable. Every crash is labeled complex. Every bailout is called necessary. But what if there's a pattern hiding in plain sight? Because after every crisis, one institution becomes more powerful. Central banks, they never disappear during turmoil. They expand, setting the stage where this power began to understand the pattern. We go back before central banks ruled the global system. In the 19th century, money was anchored to gold. Governments couldn't print freely. Bank failures were painful, but contained. Then came recurring financial panics. 1907 shook the United States banking system. Private banker J.P. Morgan personally intervened. The solution that followed wasn't less centralization, it was more. In 1913, the Federal Reserve was created, sold as protection against instability, marketed as a guardian of economic order. But it introduced something new: centralized control over money supply and centralized control over interest rates. Origins. The first expansions. World War I accelerated everything. Governments needed money. Taxes weren't enough, so they borrowed. Central banks financed war debt. Gold constraints weakened. Paper currency expanded. Emergency powers became normalized. After the war, the system didn't fully reset. The Great Depression struck in 1929. Credit had expanded aggressively during the 1920s. When the bubble burst, banks failed. Central banks were blamed for tightening policy too late. The solution? More authority? More oversight? More control over money? Rise when money lost its limit after World War II? Bretton Woods tied currencies to the US dollar. The dollar was tied to gold. This created stability temporarily. But government spending kept rising. Wars, welfare programs, deficits. In 1971, the U.S. ended dollar convertibility to gold. Money was no longer anchored to scarcity. It was anchored to policy. Central banks now had unprecedented flexibility. They could expand money supply without physical limits. Interest rates became the master lever. Breaking point: the boom-bust pattern. Lower rates encourage borrowing. Borrowing fuels asset bubbles. Asset bubbles create artificial prosperity. Then rates rise. Debt becomes expensive. Bubbles burst. Recession follows. This pattern repeated in the 1980s. Again in the dot-com crash of 2000. Then, in 2008, the housing collapse. Before 2008, rates were historically low. Cheap mortgages flooded the market. Housing prices soared. Risk accumulated quietly. Then the Federal Reserve tightened policy. Default spiked. Lehman Brothers collapsed. Global markets froze. And what happened next? Central banks stepped in as saviors. Fallout power: after chaos, trillions were injected into the system. Quantitative easing began. Central bank balance sheets exploded. Near-zero interest rates lasted years. Markets became dependent on liquidity. Global debt surged beyond $300 trillion. After the pandemic, stimulus reached historic levels. Money creation accelerated at record speed. Inflation followed. Rates rose aggressively again. Banks wobbled in 2023. Emergency lending facilities reappeared. The pattern repeated. Failed fix: reforms that expand control. Each crisis brings promises of reform. Yet after every collapse, central banks gain more influence, not less.